think the consumer is getting more and more stretched, and at some point you're going to see it reflected across the board in consumer spending. But you're 100% right. Changing your kind of ways of doing things. People are used to spending money, especially post-COVID. They wanted to go out. They wanted to do things. They said, who cares about running up debt? I want to get out. I want to travel. I want to see people. And I think that kind of mentality is very hard to break. And we've seen consumer debt, like you said, skyrocket, credit card debt, skyrocket, even car loans. Look at the defaults starting to hit on car loans. Like, there is a tidal wave coming that should hit in the next 3 to 6 months that I do say, I will go on record and say, second half of 2023, we will see the
You heard it right. In this video, Gareth Soloway from the InTheMoneyStocks.com and VerifiedInvestingCrypto.com, a master trader with 20+ years of experience, predicts that we'll probably see an awful scenario that will affect everyone. This includes stocks, Bitcoin, and obviously the macroeconomy. So please watch this video carefully until the end so you don't get caught in this tidal wave of debt. First, have a look at the S&P 500, which usually correlates to Bitcoin and crypto and shows what's about to happen.
So according to the charts, it's saying not so much, right? It's not to say we can't have a little upside, but there's still some major headwinds that the market has to digest out there. And interestingly enough, if we look at the S&P 500, in fact, let's jump right into the charts. What we can see is that basically from the initial move down, where we bottomed out in approximately June of 2022, we've now seen this sideways chop. And again, look at that. Really, the low here, I mean, you briefly violated it in October, but aside from that, you've been going sideways for a long period of time. Now, when you're a technician like myself, you start to recognize that a pattern like this is what we call a wedge pattern, right? And there's a defined wedge pattern here that unfortunately is more of a bearish wedge, right? You have a down move and then the wedge of consolidation is occurring here. So to me, it's a matter of time until the next leg comes in here. We're seeing the dollar pop today. That could be a headwind if the dollar continues to strengthen, as it's telling us the Fed may continue to raise rates. But bottom line is, investors should be very, very careful. I myself am mostly short at this point in time on the markets, just waiting patiently for that next leg lower. So I'm a trader. I'm at my computer 24/7 almost. I mean, I sleep a little bit, but for the most part, I'm always monitoring during market hours. So I use what I call mental stops. The reason why I'm a little cautious on physical stops is when you deal with significant size, the algorithms can pinpoint where your levels are, and they tend to run your stops. And the term run your stops means basically they say, oh, there's this many players at this price that have a stop. Let's quickly tag them, make them get out of their positions, and then we'll move it in the correct direction. So for me, I'm a big fan of mental, as long as you have the discipline, which a lot of people don't have. But if you have the discipline to go by mental stops, then you want to use mental stops versus physical.
What if you don't have the discipline to do mental stops? What should you do?
In terms of the charts, right? So let's go back to the S&P 500 and take a look here. So what we see here is that you're in this wedge pattern. If we were to break above this wedge pattern, you'd have to assume this is the beginning of a move up. It doesn't mean we're going back to all-time highs, but we're likely going up to this 4320 level on the S&P 500. So really, once you're above this yellow trend line, that would be where you would say, okay, you now have to exercise that mental stop or physical stop and exit the position. But right now, again, notice we're having a nice little down day. We're hammering on this trend line. If this trend line breaks, this is where the next leg lower should kick in. And ultimately, I think I still have it pinned in that we're going down to pre-COVID levels on the S&P 500. That's around 3375 and potentially as low as 33,000 on the S&P.
Now Gareth will explain what's happening with the recession and what we can expect in a few months before we check crypto. Please listen carefully.
I think you're in a totally new environment, right? We've been addicted. It's an economy, an investable market that's been addicted to interest rates. In fact, it's so crazy. Like if you talk to economists, if you talk to investors, what do they say? They say, oh, don't worry. If we go into a recession, the Federal Reserve will print money to get us out. Think about that statement. You're basically saying that the economy can't get us out of a recession by itself without the help of printing printing of money. And that's ludicrous, but that's the situation that we're in right now. So you have to be on the awareness side that at this stage, the Fed is going to be very nervous. They've been bitten by the inflation bug. Remember, they said transitory. It was anything but transitory. And that's going to make it a situation where they're going to be very reluctant to lower rates unless inflation goes below 2%. And I don't have that penciled in for multiple years. So what is that going to mean? It's going to mean we're going to slip into a recession. Essentially, they're not going to lower rates to get us out. They're not going to print money to get us out for a longer period of time. And that puts us in a potential recessionary period for 2 to 3 years at minimum. I think the consumer is getting more and more stretched, and at some point you're going to see it reflected across the board in consumer spending. But you're 100% right. Changing your kind of ways of doing things. People are used to spending money, especially post-COVID. They wanted to go out. They wanted to do things. They said, who cares about running up debt? I want to get out. I want to travel. I want to see people. And I think that kind of mentality is very hard to break. And we've seen consumer debt, like you said, skyrocket. Credit card debt skyrocket. Even car loans. Look at the defaults starting to hit on car loans. Like, there is a tidal wave coming that should hit in the next 3 to 6 months that I do say, I will go on record and say, second half of 2023, we will see the recession hit. To me, the recession is going to be a slow rolling recession. It's going to be one like the lobster in the hot water. And I hate to use that kind of imagery, but ultimately where it slowly heats up. And I think initially people are going to say, okay, it's not really going to be that bad. And the Fed probably calms us down by saying, oh, it's not going to be that bad, just like they said it was going to be transitory on inflation. So they have a tendency to understate what's going to ultimately happen. And investors have to be prepared on the other side for something much, much worse. But because it's going to last so long, it's going to continually get worse and worse and worse. But the Fed is unlikely to come to the rescue, at least for the first 12 months of this recession, due to inflation's high levels. So that's going to make it, by the end of this recession, it is going to be nasty. And I think we could be, and I said this before with you as well, I'm looking at no new highs on the S&P 500 for 10 to 15 years. I think that we're in a recessionary period for at minimum 2 to 3 years, and it could even be dragged out longer. Eventually, unemployment goes so high that even if inflation is 3%, the Fed will come to the rescue eventually and stimulate. And again, I'm talking unemployment could be north of 8 to 10%, and then they're going to be forced to stimulate to kind of bring that down.
So, knowing that a deep recession is still coming in and we're looking for a fall in the S&P 500, what is the outlook for Bitcoin? Will it be dragged down as well? Here's what Gareth has to say.
That's kind of the unlikely scenario, but if we were to get into a cataclysmic collapse in the equity markets, in the Bitcoin and the crypto markets, then that likely would be the bottom. And the reason I came to that conclusion is essentially during the dot-com era, Amazon dropped 95% from its highs before obviously recovering to the record levels that it hit over the last couple years. So that 95% mapped out to Bitcoin would bring us back to about 3,500. Now, for me, that's not really the likely scenario. I'm at a 12 to 13,000 high-end target with a low-end target of 9,000. But I'd just like to show you here. This is the chart of Bitcoin. And what we can see very clearly here is that we've had a big rally. A lot of people, like if you go on Twitter, they'll say, oh, it's the bottom. We're going to start a new bull market. I disagree. If you look at this M pattern, look at the M pattern. The second portion of the M is higher than the first. Now let's go back to the all-time highs on Bitcoin and look at that pattern. This is a classic topping pattern. So for me, what we've seen recently is actually a bear market rally. We've now come off of that 25,000 retrace with a bear flag. We then dropped, and we're now bear flagging with a likely downside move to at least 18,000 and change. And ultimately, I do think that we're going to see 12 to 13 and eventually 9. And think about this, right? You're in a scenario where if I'm correct that the economy is going to go into recession, then you're looking at the stock market probably with another 25 to 30% down from here on the S&P 500. Now tell me how Bitcoin doesn't go lower if the S&P drops 25 to 30%. We know it's a risk asset, at least right now. That's the likely outcome to the downside, in my opinion. Generally, the Bitcoin bear market, 2 years, give or take a little bit, like you're saying. And the issue here that I have with that is that, number one, we don't have a lot of historical bear markets in Bitcoin, 2 to 3 bear markets since Bitcoin's inception. The other issue is that if you look at when we came out of that bear market in 2019 to 2020, it coincided with the COVID collapse, which then triggered the Federal Reserve to print more money than we have ever seen printed in history. And so the question is we're now in this new environment where I think we just it doesn't mean that the cycle won't play out exactly like it has. It just means we have to, as investors, take that into account, that there is no printing of money going on from the Fed and interest rates are a lot higher. So there is a precedent now that if you map that out, the Bitcoin bear market could even last a little bit longer, much like the stock market bear market.
Knowing this, how would someone position in Bitcoin to profit or at least protect their wealth from a possible extended bear market?
And I do have a little Bitcoin on the long side as well. So I'm a little hedged. I'm kind of short alts right now versus being slightly long Bitcoin. But the key is this, is it's a very, very small position. And what I want people to understand is that you can still accumulate in this lower range. I'm still a huge long-time bull or long-term bull on Bitcoin. I still think it's going much, much higher than even 69,000. It's just you have to give it enough time to kind of digest what the Fed is doing and kind of cycle out all the weak hands. So again, for me, it's just going to be continuing to accumulate. We get to 15, we get to 13, we get to 10, to 5. I will continue to kind of accumulate with a long-term view, but I'm not going to be someone that's chasing it at 25,000 on a pop here. I want to be patient. I want to be disciplined. And that's really what traders are going to be, right? If you're a successful trader, you are uber disciplined. Patience is the hardest thing to be. And the beauty of it is this, right? Is that I've been wrong on trades before. I've been wrong on many, but the key is that what I always understand as a technical trader is that if I miss one today and I'm wrong on it, there's always another one tomorrow. And that's the beauty of trading gold and silver and Bitcoin and ETH and stocks. And I mean, there's just so many things to trade that who cares if I miss one? Heck, I miss them every day. All you got to do is capture one or two here and there and you become a millionaire.
What would make Gareth change his mind and be confident to long Bitcoin again?
The things that I would look for is all-out panic, which we haven't seen. Even when FTX collapsed, you didn't get a crazy amount of panic. You still had a lot of bulls that were still ready to say, no, don't worry, this is going to be fine. It was kind of the closest thing to that, which did mark a short-term low. But I still think you have to get to a point where, like in 2019, when we were at the lows, I still vividly remember, you know, CNBC had talked about Bitcoin every day, and they had the ticker of what the Bitcoin price was every single day. And by 2018 into 19 in the bear market, they took it away and they never talked about it. And that was a signal to start accumulating. So essentially, when everyone else turns ugly bearish, where they're starting to write it off, that's when an investor like myself starts to inch in. I also think you look for technical levels like the pierce of 10,000 to the 9,000 target. Think about how many stops will be right at that 10,000 level that'll get wiped out. You'll see major panic below 10,000 because it breaks the even number. Those are the signals that I kind of pay attention to.
Do you think Gareth is right? Let us know your thoughts in the comments below. And if you want to see more curated interviews like this, please leave a like and subscribe. And don't forget to share it on your social media to raise awareness and help your friends and family. Thanks.